Mahantesh, you're of the view that this time around the Nifty profit growth overall could be 10 to 12% on year, but you believe that the mid and the small caps could see better growth. Which exactly are the pockets that you're bullish on in terms of earnings from the mid and the small caps?
So we are looking at the mid and small caps in the consumer sector, for example, some in the construction space, some in the small PSU banks. PSU banks wouldn't be classified as small caps, but they definitely are in that mid cap range, and we think there is a lot more action that one can witness there. And to some extent, some of the other financial companies, NBFCs, can do really well.
Okay. Mahantesh, wanted to understand what is it that you're expecting Reliance to deliver, because there's much heightened anticipation, not as much from the oil and gas business. There we are expecting a muted performance. But what could be the announcement on perhaps Reliance Retail, what the pricing strategy for Jio going forward is, and how do they plan to really sustain the cash guzzler, which is Jio?
So first, a disclaimer here, I own Reliance stock, but answering your question on the expectation for Q3, I think the major eyes will be on what's likely to happen, as you rightly mentioned, on the retail business more than on the oil and gas business. And more particularly, there will also be attention towards what is the strategy that will be played out on the telecom side that they have. The key deliverable or the key monitorable in the results will be not just the profit growth there, but how is the cash flow generation happening in that business. As we know, it is a business where huge amount of capex has already taken place, and there is an ongoing sort of discounting war. ARPUs are falling, as you are aware. That will be the monitorable. So from Reliance point of view, we think if the cash flow generation is reasonable enough for the overall debt levels to remain either steady or trend towards coming down, I think it will be a stock to watch out for.
Okay. Other than that, what's the outlook when it comes to the consumption space? What are you expecting from the likes of HUL as well as ITC in the quarterly numbers? How do you see the overall volume growth trend for the space as a whole?
So for the consumption companies, we have been seeing that the volume growth has been quite strong. In the past, most of the companies have been able to deliver either double-digit volume growth or close to double-digit volume growth. The first of the block in terms of its Q3 results was Bajaj Corp, or what is called as Bajaj Consumers now. They had an overall volume growth of about 7%, if I recall correctly, and their flagship product, which is the hair oil, almond drop hair oil, there the growth was about 9% in terms of volume. Bajaj Corp has shown the way, I would say, in the sense that consumption stocks will continue to deliver strong volumes growth, and we should therefore see profits grow quite faster. That could be, depending on the segment, a pressure on the margins of some of these companies. But nevertheless, we see that consumption story remains quite strong.
Okay, you also like the BFSI space as a whole. What are you penciling in by way of earnings? Are there any specific names that will stand out?
So we are looking at the public sector bank space, particularly in the BFSI, like I had alluded to earlier. We expect that, just as we had seen in the previous quarters, the incremental slippages will continue to fall. Profit growth will be very high given the low base. But the key monitorable again here would be the NPA ratios. We expect the NPA ratios to gradually come down. That's in a way getting factored in partly in the stock prices as well. You would have noticed that the Nifty PSU bank index is up in the past odd month relative to the private bank index. That partly tells you the story that the expectations on the PSU banks in terms of their numbers will be very high. Another pointer is that the bond yields have softened, and that should mean useful treasury profits also can accrue to some of the PSU banks.
Actually, right point over there, because we have seen even from shorter term perspective, Mahantesh, that PSU banks are doing really well, and point well taken that most of the gains of falling bond yields are seen in the treasury books of PSU banks. My question to you is more on auto ancillary space and tire space. Now, one would argue that probably the auto sales numbers are declining, and that can be one of the reasons why tire stocks are correcting, but the replacement demand continues to remain robust. Crude oil prices have fallen down, so that also ensures that there may not be significant margin pressure unless until you are a highly debt-laden company. How are you viewing this space? Is this a good opportunity which investors are getting to buy on dips, or you think one should avoid tire space?
No, I think you put it quite rightly when you said that tire companies actually have a lot of significant presence in the replacement markets. Actually, replacement market is the one that drives the profitability for these companies, and therefore the stock prices. OE is just a small portion of their business. Very often that is not meaningful enough to push the needle. Therefore, replacement demand is what we have to always watch out for. The replacement demand continues to remain strong. A corollary of that is if you look at the toll roads and the toll collections that are happening and the passenger traffic growth that we are seeing on major roads, it tells you that it's rising quite steadily up, which in turn induces replacement demand for tires. Therefore, we see that the demand for replacement tires will continue to remain strong. The only problem could arise from Chinese tires, but fortunately there are certain measures being adopted in terms of anti-dumping duties which favor the domestic tire manufacturers. And yes, you did point out to the fact that with crude remaining at a softened level always helps the tire companies to better their margins. So margin prospects are going to be good, volume prospects are good, so tire companies should be able to deliver good profits going ahead.
Okay. Where else do you find opportunity right now, Mahantesh, in the market? Any other pocket or segment within the mid and small caps where you think there is growth visibility and attractive pricing as well, thereby, it's a right buy right now?
So we have been selectively looking at certain companies. For example, we had recently initiated a coverage into liquor companies. Home Distilleries, for example, is one of them. We think that will potentially do well. Certain auto ancillaries can actually deliver better results as we go forward, partly due to their own expansion plans that is happening. And I'm not referring to the general volume slowdown that is happening. You have to look at auto ancillaries who are able to better the share of business through wider product offerings and more capacities coming in. So there are a few opportunities in the ancillary space. Beverages I have talked of, so likewise there is food companies also who can potentially do well. DFM is something that we have been looking at. So these are some small cap kind of companies. In the large caps or the mid cap companies, we should be focusing, like I said, on the consumption story, not just FMCG companies but consumer durables as well. So the likes of Crompton Consumer to a Voltas to a Blue Star are something that we always give tactical buy calls on.
Mahantesh, what is it that you're looking at with the likes of Page Industries and some of these other so-called 5-digit expensively valued stocks? Do you see some sort of potential here? So
I think Page Industries as a stock has not featured in our radar over, I would say, over the last 1 year or so. Yes, they are expensive. We tend to ignore some of these stocks given the expensive valuation, and not just that, sometimes even the price per share becomes a hindrance when it comes to retail investors, buying psychology. That said, there are high price stocks that we do recommend periodically. One of which I would say would be an Eicher Motors. We've had a sell call which has been quite successful in the past, but then the stock has, I would say, dipped far below its fair value right now, and it can potentially start bouncing back as the sales momentum recover from a low base. So that's one that we would look at. But from an expensive stock perspective, you can even look at such names as, let's say, in the consumer space, such as a Lever, for example. So they are expensive in terms of their PE valuation. That is a call that we've recently been giving. And should potentially do well. There is M&A activity, consumption story continues to remain strong, and cash generation is quite robust. Yes, so some of these companies we will certainly look at, but expensive valuations, we really want to see to it that expensive valuation is because of good corporate governance standards, strong promoters, and not merely because there is a potential growth ahead which is overestimated.
So it's not just a quantitative but qualitative aspect one should concentrate on when you look for expensive stocks to buy even at expensive valuations. Mahantesh, thanks. That was an interesting U-turn which you're making on Eicher Motors successfully though. Thank you for joining us and sharing your insights on markets and some of the interesting stock ideas which we discussed.